Hello and welcome. I hope everybody's doing well and ready to begin chapter 2. This is a critical chapter in terms of really completing the rest of the course, and it's in a lot of ways is the foundation for what everything else is going to be all about. So certainly how debits and credits work and how accounts work is a real essential tool in this course. So we're going to try to dive right into it, and I just want to share a little bit of information. If you go to your PowerPoints, you'll see a couple of things, and we'll just kind of begin from this first slide here. A ledger is basically a chart of accounts is a listing of your accounts, and in a lot of ways it follows the form that you've learned already from the accounting equation, where you had your assets equaling your liabilities and your plus your owner's equity. And so you typically begin with your assets and you rank them in terms of closeness to cash. So you'll notice the cash over here is listed as 101. That 1 represents an asset. 0.1 represents how close to cash it is. Well, nothing's closer to cash than cash. Accounts receivable would be an item that was used where you generated revenue as a result of sales or whatever, but instead of somebody paying you with cash, they gave you a promise to pay you in the future. So that will eventually become cash. That's why it would typically be listed after cash. And then with supplies, of course, you're going to use those in production to later generate revenue. But as you can see, prepaid insurance equipment, the further on down the list you go, the farther away from cash that it is. Same thing, liabilities. If you look at those, I've got accounts payable as listed as 201, 2 representing a liability for whatever naming convention you could use. But typically, you're thinking of 1 as an asset, a 2 as a liability, a 3 as an equity, 4 being revenue, 5 being expenses. So that's how those numbers kind of correlate. Same deal, though. An account payable, you're going to be paying that back. That's a debt that you owe to somebody that you're going to be paying back later that they will then convert to cash, which is closer to cash than unearned consulting revenue in this case, and so on down the line. I say all that to move us into, again, kind of go with an overview of the types of accounts that we have. This week, we're going to learn how these accounts work. And to begin that, we need to begin with the concept of debits and credits. And a lot of times people make the confusion or make the assumption that, a debit is always going to be a decrease, or it's always going to be an increase, or the same thing with a credit. And literally all a debit or a credit means is a left or right side entry. It really matters what type of account you're applying the debit or credit to see how it behaves within the account. But truly, when somebody says debit or credit, they literally just mean left or right. That's all that means. So we'll see how that works here in just a second. So going back to our entry, assets equal liabilities plus equity. So looking at this, assets, notice it being on the left side of the equation, is increased with a debit. You see over here that the normal balance is a debit balance. And so if you began with $100,000 in assets and it was a positive balance, you're going to see that $100,000 sitting on the left side of this T equation over here, okay? Whereas liabilities are on the other side of the equation. Same thing for equity. These are going to have a normal balance of a credit or a right side entry. So if you have a $100,000 asset and an $80,000 loan against that asset, the asset would have a debit balance of $100,000. The liability that you would owe would have a credit balance of $80,000. And then where would the other 20 be? You're right, you probably guessed it. It's going to be sitting over there in equity, which also would have a normal credit balance to represent an increase. So let's think through some transactions here and just kind of look at this, and I'll give some examples. I'm going to share the screen and move over to this Excel spreadsheet that I prepared. And let's just talk through that example. So let's say I had $100,000 in cash. And say I have an account payable that I owe that is in the amount of $50,000. And let's extend this forward a little bit, because I do need to make sure my equations are balancing. And then we'll just call this net worth for the purposes of illustration. So $100,000 on the debit side or left side And then this plus this, save that for us, $100,000 on the right side. So I've got 100,000 in cash. Let's say then that I make the decision that I'm going to pay off 10% of the debt that I owe. Well, 10% of 50,000 is 5,000. So if I was going to illustrate that, I'm going to show a $5,000 credit entry on the asset side and a $5,000 debit entry on the liability side. And when I do that, my new normal balance in cash is going to be $95,000. My new normal balance in accounts payable is going to be $45,000. And in this situation, because the effect was between assets and liabilities, there is no effect on equity. So equity just remains $50,000. So in this situation, it's true that the amount of assets that I have on hand has now decreased by a certain percentage, by 5%. But the amount that I owe has now decreased by 10%. And so when I add all of these things up, I find that, once again, as we would anticipate, I'm still in balance and I still come back to my accounting equation. So in the previous chapter, we would illustrate this kind of thing. We would have shown $100,000 and a minus number, minus 5,000, for instance. That's not how accounting works. And it's really important to realize that, the way that these accounts operate, because if I've got a normal balance, I need to know the corresponding decreasing balance to be able to record this appropriately. It's really important to get this, because if you look at assets being increased with a debit, being decreased with a credit, liabilities being increased with a credit and being decreased with a debit, equity being increased with a credit, and then decreased with a debit. Revenue, how was that going to behave? Well, revenue is going to be exactly the same as an equity account. If I had, let's say that let's just take this here. I'm going to borrow this for a second. And let's say that I make a sale, and we're going to say the person pays me with cash for $1,000. That's going to be $1,000 credit entry. And the other side of that is going to be cash. So now my normal balance in cash is 100,000 plus this new sale, minus the expense, of course, or minus the reduction in liability. And now I have a new item, revenue, as a result of sale, which means that now, where does that go? Well, revenue is going to ultimately net up into equity. So what's going to happen as a result? My assets minus my liabilities are going to give me my net worth. And my net worth is going to be the 50,000 original equity amount plus the revenue that I just earned. Expenses, if you had an expense entry, that would behave like an asset. It's going to be the opposite of a revenue entry. So an expense entry is going to be, unlike where revenue is increased by a credit, expense entries are going to be increased by a debit. They are the opposite of a revenue account. So if a revenue by extension increases your equity or your net worth, an expense is going to be a reduction of your net worth ultimately, because it affects your bottom line in an undesirable way. Now, of course, expenses have their purpose and we need them, and sometimes we need them in production, but that's going to be how it affects us as a whole in terms of our permanent accounts, assets, liabilities, and equities. So again, just wanted to give a brief introduction and kind of talk about this a little bit. It's a lot to comprehend. If you have questions, please email me, please call me. I'm glad to help, and I'm here to help. And we'll do some more follow-up this week. Thank you so much. Have a great afternoon. Bye now.